Hi, my name's John Holman. This topic is escalation, the forgotten risk. A little background on myself. I'm the owner of a consulting company, Validation Estimating. I've been doing that for the last 15 years. I have about 40 years of experience, so I guess that gives away my age. Included in that experience is a number of years with a benchmarking firm, Independent Project Analysis, or IPA, and that included years of studying the topic of escalation. Escalation is very near and dear to IPA's business model in that they have to keep their historical database current. So the level of understanding of the topic was very high there. I have experience in a number of industries, mainly in the estimating, risk quantification, and project control fields. I've been very active in AACE International, including on the board of directors and on the technical board. I have helped develop recommended practices, including on escalation, among other task and volunteer efforts there. I've written a couple of books. The most meaningful one for this talk is Project Risk Quantification, which was published in 2016. So that book is available in hard copy or Kindle version. If you want to check it out, there's a link there. I want to point out that escalation is covered in two chapters. One is chapter 4 and chapter 13 in respect to how to quantify escalation. Last year for the Risk Week 2019, I presented on the general book methods and content. So if you want to go back and look at that, that might help you out. So the title of this talk is Escalation, the Forgotten Risk. And what I want to review in the first half of the session is some of the reasons or the false assumptions that have led to escalation being forgotten, or it's an oversight in most risk quantification efforts. And the reasons in summary here, which I'll go over, include opinions or assumptions that, for example, why should we worry about escalation if there's no inflation, which is pretty much the case right now. There hasn't been much general inflation in the economy for many years. The other false assumption is that some people feel that escalation is relatively negligible, but we're going to show you that escalation can be devastating to project cost outcomes. And as it mentions here, it's kind of a sleeping tiger that comes up to bite you when you least expect it. Third point is that the business may view revenue as king. And if revenue is going up, the prices of the thing they're selling are going up, why should we worry about the capital cost escalation, which is trivial? But what we're going to show you is that escalation tends to be collinear with revenue price changes. So it tends to spoil the net present value that you were hoping for. The fifth point is that there's a belief that finance department, who does the net present value and other business evaluations, has escalation covered in their models, but we're going to show you that's not true. Generally speaking, they don't understand escalation, and they certainly don't model it very effectively. Another misconception is some feel that it's in their risk register and may or may not be carried forward in their normal risk quantification method. But I've not really seen that in my benchmarking experience. It's not done well. One thing we need to recognize is escalation. I call it the grim reaper of delay risk. So with delay risk being so dominant in a risk register, we need to address the escalation impact of that. The next point is that some feel that the published price indices they're using to estimate escalation have the problem covered. But we're going to discuss with you the fact that there are no published indices for services that are bid, and we're going to discuss how to deal with that problem. And then another view from procurement is that if my contract has an escalation clause, then I'm covered for it. But that brings us back to the problem of the indices we often use in those clauses are not really very good fit to the situation. So what we're going to present here is going to review these points to make sure you know what the challenges are in dealing with escalation. And then in the second half, we're going to talk about some methodology for quantifying escalation risk that address all of the causes of it being forgotten above. So let's start with the issues that come up about escalation. First one is the false belief that we don't need to worry about escalation because inflation that you see in the newspapers is negligible. What we need to recognize right off the bat is escalation is not synonymous with inflation. Inflation is just the starting point. Inflation is simply the change in, it's a monetary issue, in the purchasing power of money is going up and down. Basically, as the government prints more money without any reserves to back it up, that the value of that money is going to decrease. And when that's true, everything on the market goes up and down with the value of the money. But what escalation is are changes in prices due to a number of reasons, including technical and economic and market conditions. And those market conditions can be specific to a region, they can be specific to a commodity, and the supply-demand situation for that commodity. So inflation, like I said, is just an underlying element, but escalation is so much more than that. I mentioned that escalation includes things like productivity and technology, and a lot of people kind of lose sight of that. And what I mean by that is that when the economy is hot, let's say the engineering and construction market is a lot of demand, that there will be a shortage of skilled labor. And when you have a shortage of skilled labor, you're going to have worse productivity. The productivity is going to trend downward for everyone. So it's not specific to your project. It's something that applies to everyone in a region or in a market. That is escalation, not a specific project risk. And our price measures have to reflect that. If you think about the contractors and the fact that they are experiencing productivity issues, so what are they going to do in their pricing when they bid a lump sum bid? They're going to have to increase their prices. So that's how labor productivity finds its way into the escalation equation. But there are, again, many other situations that are covered by escalation. It's not just monetary. I do want to share with you some data to demonstrate how escalation differs from inflation. So the chart on the right, what you're looking at is on the x-axis, we have the years, and this covers the period of what we call the super cycle. The super cycle is that when commodities, China demand increased tremendously for commodities, the supply was limited, so the prices of commodities started shooting through the roof. And when that happened, many companies in the commodity world started approving projects to capitalize on the situation. There was only so much capacity to construct that type of work, so the prices started going up. So what you see on the chart in the dark line at the bottom is the U.S. Consumer Price Index, which is somewhat of a measure of general inflation. The middle line in the heavy dashes is the Chemical Engineering Magazine Plant Cost Index, which is derived from the U.S. Bureau of Labor Statistics cost indices. And this kind of reflects the cost to a first-tier subcontractor. It includes the wages they have to pay, the materials they have to buy, and so forth. The dash line, the small dash line at the very top, is a measure of the price that an owner would have to pay to get a process plant constructed. This would include the impact of markups and margins in the bids that they receive from engineering, fabrication, and construction contractors. And you can see that the price increases were about triple the level of the consumer price index. And the magazine indices that many of us use, like CHEPSI, or the Chemical Engineering Plant Cost Index, was only covering about half of the situation. So depending upon where you fit in the market, whether you're a first-tier subcontractor or whether you're an owner that is subject to all the margins and markups that accumulate up the chain, the index escalation impact to you is going to be quite a bit more than you might have expected. There's also the case of capital demand in a local market driving escalation, and it may be very, very regionalized. An example I have here is something I call the Goodyear rule, and the reason I call it that is because the former CEO of BHP, which is a major mining company, once said that, you know, every time a project opens up next to my project, the cost of my job goes up about 10%. And amazingly, when you do the math and look at the history, that was a pretty good representation of how the capital demand in a local region drives the prices for everybody working in that region, everybody that's sharing the same labor pool and so forth. So, you know, as we go forward, we'll talk about the effect of capital demand, but this is just a takeaway of how, you know, we understand that, we see what's going on, but we often kind of forget that escalation has a major impact on our project, and we can't forget it. Now, we're in a current state in our economy right now, which is relatively quiet in terms of escalation. This is quite typical over the course of the years, is that we have periods where inflation and escalation are relatively quiet, just several percent per year, but that is interrupted by periods where escalation takes off and breaks out. And that is what we're trying to anticipate in the future. So, you know, we've had about, you know, since the end of the super cycle around 2012, a fairly quiet period. So the question is, after, for example, COVID situation is done, will there be a resurgence in capital demand? And if there is a resurgence, how is that going to affect the pricing level for the work that we are right now evaluating? A lot of my clients right now are looking at capital projects that are going to execute in 2022, 23, 24. So the question is, where is this going when the COVID dampening is past us? And in terms of, you know, how often this happens, this is a diagram from a paper from the 1980s. For those of you that were around at the time, oil price went through several shocks as the Middle East, you know, throttled their oil supply up and down. And you can see in this paper that in the 1970s, there was a increase in the capital cost to execute a major project, pretty much just like happened during the super cycle in, you know, 10 years ago. Now, another situation I pointed out where why escalation is forgotten is that when revenue goes up, for example, in 2006, 7, and 8, when copper and gold and oil prices were escalating dramatically, the businesses tended to just chase revenue. Let's get that project built so that we can capitalize on this tremendous revenue opportunity. But what they forgot, virtually across the board, all of the mining companies and oil companies didn't recognize that the capital cost was increasing, not quite the same level, but increasing substantially and eating up all the potential profit that may come from that revenue. So there's no free lunch when the revenue goes up. We have to be cognizant of the fact that escalation is correlated with the revenue side of the NPV equation. Okay, next challenge. A lot of folks feel that finance has responsibility for inflation and escalation issues. And in effect, they feel that finance is indemnifying, the project community, that they've got it covered. Well, that may be true for nominal inflation, the monetary impact, which is included in the discount rates of the NPV models and so forth. But finance really is not very familiar with escalation. They don't model it, don't frankly understand it very well. So what's happened is that while they're indemnifying the project, they're not really aware of what they're indemnifying them for. And so companies are continually kind of get bit by the escalation tiger because nobody's analyzing that risk. The projects aren't analyzing escalation risk, and finance themselves are not even aware of it. So you cannot just assume finance has it covered. In a volatile market, somebody has to be doing escalation probabilistic analysis. I just mentioned, doing escalation probabilistically. Some feel that, well, probably finance again is doing that in their sophisticated models. Well, no, they're not. I really can't even point out to you a company that does good, reliable escalation forecasting using a probabilistic method. Certainly the project teams are not, and we're going to talk about that in a minute. I have in a small bullet point here, kind of a cynical view, is one thing I found back in the super cycle is a lot of projects really weren't too upset by the fact that their project costs were going through the roof because they could blame all of their bad practices on escalation. It was kind of a hidey hole or covered their rear end, so to speak. It was labeled as an unknown, even though it was highly predictable. Once the super cycle started, there was really no excuse for not quantifying it. But it's an easy way for everybody to hide. We can just blame it as a black swan, and we shouldn't be doing that. Another misconception is that escalation is included in various items in a risk register. For those of you in risk analysis, you're aware that the registers have, dozens or maybe even hundreds of risks identified, and many of them have the words, the price may increase for steel, or the price of the wage rates may increase, and therefore feel that their method has escalation as a general concept covered. But what we find is that that method of looking at little pieces and parts of escalation for a few key items is going to miss the boat, because escalation is not in small dribs and drabs. Escalation is an overarching risk impact and something we have to quantify distinctly, as opposed to letting it ride in your register as items that may or may not cover one or more parts of the equation. So if you're going to quantify it as just another risk in your contingency, that's better than nothing, but far from ideal. Okay, the next challenge we have in the why is it forgotten is that many do prepare a fixed estimate of escalation, a point estimate. And they have escalation indices from the magazines or from the Bureau of Labor Statistics or StatsCan or some other source like that. And they look at the commodities, maybe the labor, the wage rate, the steel, the concrete, and they'll apply those indices to those items and come up with a point estimate of escalation. That's, again, a good starting point. It's better than nothing. But we're going to talk later about why those indices may not apply. And secondly, why we need to do it probabilistically, that the magazine indices are not going to cover the risk of the situation. Now, this last point gets back to procurement. Often they'll include in the contract an escalation clause based on some published index, so that if the general market price goes up for something you're buying, that the contractor is covered. So basically, the owner is taking the responsibility for the risk. But if you're a contractor, you need to be aware that you may not be transferring that risk as well as you think. And as we talk about the quality of the indices and how well they work, you're going to find that you may not be addressing this risk fully through your escalation clauses. So those were many of the reasons why escalation is ignored, forgotten, shoved to the side. Hopefully we've gotten a point across that you can't do that. We have to measure and forecast the escalation and quantify it probabilistically. So let's talk about some methods that we can use for that. So the challenges when we get to the quantification step is that there's some steps we need to follow to address this. First, we have to start with a solid base escalation estimating model, which applies meaningful price indices against cash flow by specific items in your estimate. The indices that we use, they have to come from a good source, and that's going to be the econometric consultants out there. I won't name them here, but there's a few major consultants that provide these indices. We're going to have to adjust their indices, and we're going to talk a bit about why their indices don't match the prices of services that are bid. I call it the CapEx adjustment. And then we're going to have to quantify it probabilistically. All the cash flow, the indices, the duration of the project, all of these things are uncertain. And all of them are major drivers of the escalation cost. So we can model all these things relatively simply with a probabilistic model. And if we do it right, we can include the cost and schedule contingency as inputs to the escalation model. And so the outcome of this model will be a universal CapEx risk profile to use for funding and net present value scenarios and so forth. Now, the good news is AACE International has 2 recommended practices to address escalation quantification. RP58R covers the basic method for a point estimate, and RP68R11 covers the probabilistic approach. So the methods I'm going to talk about in these slides is covered in documentation. The problem is very few are applying 68R, which is the one that's really going to give you the real benefit here. So let's go over some of these practical methods. In my book, you'll find is a methodology of quantifying risk, starting with systemic risk and parametric modeling and moving down the chain until we get to the 3rd step in the quantification, which is escalation. So there is a specific method covered in the book, and you can see that the risks are accumulating as you go along and eventually rolled up into the escalation model. And I'm not going to go over the whole book here. It wasn't the topic of the talk, but just know that this is one of a series of risk quantification methods you need to apply in order to do risk quantification effectively. The base method, I think most people can deal with. I'm not going to go into this in detail. It basically means you take a cost item, let's say it's steel, from your estimate. You get the published index from the economist. The indices is a value showing a relative increase from year to year. And we use those indices to derive the percentage increase from, let's say, today to 2024. And we just simply do that for each of the items in our estimate with specific index for that item and a specific cash flow so that we can do it period by period. The increase from today to 2023, and then the increase from today to 2024 and so forth as relevant or applicable to that item and its cash flow. Now, the indices are not that simple. You can't just grab something from a magazine. The indices, for example, from the Bureau of Labor Statistics are fairly specific. For example, for labor, they're going to have a compensation index that covers wages and compensations such as you might pay to a union laborer. But as an owner, we're not paying wages. We're paying for services, maybe from a shop or from construction. And the price of that service is not only the wage, but it's going to be the vendors' overheads, their markups, their contingency. And if it's a hot market, their margins could increase substantially. So we have to have a built-up index, and our tools and our methods need to build these up effectively. Other situations are, for example, in piping. In a process plant, we have a combination of carbon steel and various alloys. So the price indices for alloy piping can be quite different from carbon steel. So again, we have to build up indices for each of the major alloy types to make sure we get this covered properly. The next problem with these published indices is, as I said several times, they don't measure the price of services that are bid. The government, like the StatScan or U.S. Bureau of Labor Statistics, what they do is they survey the suppliers and vendors for the prices they're charging more or less for standard items like catalog items. And these are fairly reliable because those prices are in competitive market and fairly meaningful. But for an owner or a high-level contractor that is getting bids from subcontractors, that doesn't really fill the bill because the margins that suppliers are adding to services go up with the market demand. So I'm not going to get in great detail here into the math, but what we can do is take indices of capital spending. Now, there are economic government agencies that forecast capital spending for different market segments. For example, oil or chemicals or certain metals manufacturing. And they actually forecast that capital spending, let's say, may go up 20% next year. What we can do is take that forecast of capital spending, and with a little math and a little exponent as shown on this slide, we can take the underlying root index from Bureau of Labor Statistics, let's say an 8% increase in wages, and then we can take the 20% increase in the capital spending in that market to an exponent and adjust the labor cost service bid to match that. So in the example, I have an 8% underlying wage increase, a markup for the capital demand, and what that does is it gives us a 17% increase for labor services in that market. The CapEx factor can vary. So the hotter the market and the more it's an oligopoly, meaning if you only have two vendors that can provide a certain item, their market power is much stronger and their markups are going to increase accordingly. So in a oligopoly, you're going to have an exponent that's much higher than a market which has 10 or 15 or 20 suppliers. It's very competitive. So, we can develop these CapEx factors or exponents that are specific to the item and the market we're dealing with. Now, the markup, how do we know that this works? Well, this example on the chart shows a comparison of the chemical engineering plant cost index in the blue, which is a Bureau of Labor Statistics metric. and compare that to the IHS market downstream capital cost index, which is a sell price index for owner. And you can see that the Marquette index was much higher than the Bureau of Labor Statistics. So I applied the capital cost adjustment, which we just described, to the chemical engineering, and you can see that those the reddish bars pretty much matching the sell price index from Marquette. Now there is a time lag in those early years, so what that demonstrates is that the suppliers do not instantaneously change their prices as the market starts to ramp up. There tends to be a lag of 6 months to a year, and eventually they will catch up to the market, and we saw that in this calibration. So now we have a base method for escalation that covers the indices with a capital market adjustment for them. So the next challenge then is we want to do this probabilistically. So in our escalation estimating tool, we need to have a probabilistic approach. And the things that vary over time in our model are the contingency input. Contingency is a cost like any other, needs to be escalated. We have schedule risk, and we need to understand that escalation is time-driven. So any schedule delay is going to add escalation. So we can incorporate the schedule risk into this model. Thirdly, we have the price indices themselves. Of course, the market's volatile, so we're going to have the ups and downs in price in the future. And then fourth, we have variations in the cash flow pattern, meaning we're not quite sure if we're going to spend our money in year 1 or year 2. It can vary depending upon the execution and the procurement strategy. Then we have to establish dependencies between these things and then run Monte Carlo. This sounds a little bit difficult, but it's really just basic Monte Carlo simulation applied to an underlying escalation model. The most challenging thing to address is uncertainty, is the price indices themselves. These tend to follow kind of a time series behavior, meaning that if you have a very high increasing trend today, the chance of it increasing tomorrow is less. It's very cyclical. Now the length of the cycle is uncertain, but we have to be able to address the ups and downs. The model that I use has a kind of a simplistic approach to it, but we just especially need to get the range in there. Whether we get the timing exact is nice to have, but we just need to get some uncertainty into our model. We can also use scenarios for the price indices, and the econometric modelers, the consultants are very good at this. If you tell them on the revenue side of your picture, you have a scenario of after COVID, for example, we assume prices are going to increase substantially in our market. We can use that same scenario on the capital side in our escalation backup and use that to sample the variation in the price indices themselves. Okay, let's sum up this methodology. This diagram is showing the different steps. We have our estimate on the left in today dollars. We estimate the cash flow by item. We get the indices and we adjust them to the market, apply the indices to the cash flow. We apply Monte Carlo simulation to our model and we get a probabilistic distribution. So the steps are fairly simple, but cumulatively, there's a number of things we have to do right to get it right. Okay, once you have this model, another nice benefit of it is that you need to have a model like this to maintain any historical database you have. So if you have a database of past projects that you use for estimating analogy estimates or for benchmarking, we have to keep that current. So if you have developed an escalation tool, you can use that same tool and the same method for past costs and bringing the past costs up to today. So that's an additional benefit. And you need to get that right. Otherwise, your historical data is going to be corrupted and not appropriate, especially if it was captured, let's say, during the super cycle. We want to make sure we have the right indices and the right adjustments for anything in that super cycle period. So the takeaways for what we just went over. A, escalation is not inflation. We have to look at it specifically, and it varies and is usually much more volatile than inflation. We need to understand escalation covers a number of different market situations, including productivity that prevails in a market due to labor shortages because of market demand. Thirdly, we need to understand that the price indices we're getting from the consultants and from the magazines do not cover the prices of services that are bid, because the bids include margins and markups that the government services don't survey from the bidders. We need to understand that the bids correlate with capital spending, so the hotter the market, the bigger the margins and the bigger the risk that the contractors are worried about and embed in their bid prices. We need to understand there are ways to use capital spending indices to adjust the underlying price index. And then we can use all this in a normalization tool for our historical data. The fourth point is need to do this probabilistically, and almost nobody is doing that. It's forgotten. And it's kind of terrifying to me as having been involved in benchmarking and risk analysis, how what can be the most significant risk on a project is more or less totally overlooked by even the most major companies out there. But the method is highly amenable to typical Monte Carlo simulation model. It's beyond me why folks are not doing this more. So that's all I had. I hope you got something out of it. If you want to learn more, my book is available at the link shown here on the page. You can acquire it on a Kindle version via Amazon if you'd like. It's only $10. If you have any questions, I think you can post them or convey them to Alex or someone, and we'll try to answer. With that, I'm going to say goodbye and hope you have a nice day.